All right, let's look at the toolkit premiere for discounting and acceptances. So, Warburg wanted the U.S. to borrow Europe's day-to-day plumbing, meaning a discount system built on short, self-liquidating bills, usually with two or more signatures, and a market in bankers' acceptances. The idea is simple: turn good commercial credit into liquid standard paper that clears at a known rate. That stabilizes money costs, ties policy to the rhythm of trade, and gives the central institution a clean lever: the published discount rate, plus open market purchases of prime bills to steer conditions. So, the basics of these discount systems and acceptances. For one, it makes credit liquid. So a banker's acceptance, its signature, turns a one-name promissory note into a two-name bill that investors everywhere will hold, so banks can sell it any time for cash. Two, it ties finance to goods. So acceptances are meant to finance shipments, storage and transit, and short production. So it's not speculation or permanent working capital. So things are basically, things that are like actually productive and or provide goods and services. For three, it equalizes money rates. So when every region can sell prime acceptances into a national market, seasonal squeezes don't spike local rates. Domestic acceptances act as equalizers. And four, it gives policy clean levers. So a central institution can set a visible discount rate and buy or sell acceptances and foreign bills to steady the money rate, linking policy directly to trade flows. So, to start with, the European pattern around 1900. So, ordinary business, there's financed by short bills. So 2 to 4 months, most often 3, as in 3 months, that carry multiple signatures. By contrast, traditional U.S. paper was mostly single name and illiquid during stress, meaning like the panic of 1907. So the extra signatures are both credit support and proof the underlying trade is real and short term. Again, it's about 90 days. So how does a dead note become market money? So through acceptance. When a bank accepts, in quotes, a 60 or 90-day draft drawn on it, the merchant can sell the paper at the ruling discount rate, wherever and whenever needed. And the bank's name transfers the note into a standard investment tradable on rate, not on the borrower's reputation, which broadens the market and stabilizes pricing. So what do acceptances finance? Goods on the move, so trade. Documentary bills against shipments, also commercial credits, and with safeguards. So temporary storage of staples or goods in production awaiting shipment. Not okay is permanent investments, working capital, or speculation. So the point is to match credit to trade cycles so the paper self-liquidates. Why does this calm a big, diverse country like the United States? So, because prime acceptances clear at a fairly uniform national rate, unlike countless idiosyncratic single-name notes, Warburg stresses that a uniform rate for single-name paper is neither desirable nor possible. But a uniform rate for paper without commercial risk, like prime bankers' acceptances, is practical, giving banks a standard outlet for liquidity. This feeds policy transmission. Domestic acceptances let funds flow from easy districts to tight ones. Think like cotton season during the South. So local rate spikes are blunted as paper moves to where the money actually is. That's not a theory. Warburg calls them, in quotes, equalizers of money rates all over the country and provide proper warehouse safeguards that are in place. And it connects policy to trade and foreign exchange. So Warburg explicitly notes that investing in foreign bills can help steady the domestic money rate. Later chapters in his books show why a central bank with the market and acceptances can influence conditions via open market purchases more nimbly than by waiting for banks to rediscount. In short, acceptances give policymakers a tradable, trade-linked throttle to use. So today's punchline is the European-style discounting plus American trade equals a calmer, cheaper money market. Two-name bills turn credit into cash on demand, equalize rates across regions, and give the center clean levers, a posted discount rate, and an acceptance market to guide conditions without showy interventions. This is the plumbing that turns a reserve union into a, quote, working monetary system.